Hello and welcome to Jim Dalton's presentation for the Fall Intensive. This is the third of 3 webinars in a series to prepare traders for the intensive, and it also serves as a preview or an overview of how we approach the markets. So today is Thursday, September 25th. It's currently 11:30 Eastern. We'll go till about 1, and it is being recorded. So type your questions in. We'll get to as many as we can. And Jim and I want to thank everyone for being here. It's great to see you all. Any questions or things that you want to learn more about, please check out our site. There's many articles, the glossary, webinars that are free for you to learn more. So please take advantage of that resource if this is new to you and you're interested in enjoying what you're hearing from Mr. Dalton. So with that, I would like to introduce Mr. Jim Dalton.
Well, good morning. I'm going to sign up for my own course, as I'm tremendously embarrassed that I reacted a little bit slow this morning. I was asleep at the switch, and that is not a very good feeling, but it does happen from time to time. All right. Let's take a look at the slides, and remember, this is the third and last preparatory webinar prior to the start of the intensive on Monday. At the very end of this, we're going to review what we've talked about in the last 2 sessions, and you're going to see some of the slides you've seen before, simply because there is a routine that is very important. The first subject I want to talk about today is confidence. Confidence is one of those things that can be a little hard to define. I guess I've done it so long that confidence isn't particularly difficult for me. Other people, it's a little more vague. So let's try and put some kind of structure around confidence. So we have confidence on 2 levels, and the 2 levels we're going to discuss are the short-term auction and the day time frame auction. Now, obviously, it exists for the long term and the intermediate term, but we're going to focus today on the short-term auction, which are really driven by those traders that are in the market 3 to 5, maybe 10 days. Remember, we've said so many times, they have a tremendous amount of money. They're big pools, some of them, multi-millions, $1 billion, and they can move the market very strongly, but they don't move the market outside of the ranges set by the intermediate and longer term time frames. Short-term confidence, you've either got high confidence or low confidence, and we haven't said neutral in there, but we just want to give 2 recent examples of high confidence and low confidence. Then we'll take a look at the day time frame auction and talk about gaps and confidence around the day time frame and how we really look at that. First, we're looking at confidence short-term auction, example of high confidence from August 18th to the 28th. Now, some of you are going to say, well, it doesn't conform perfectly. Not all these profiles are really elongated, and sometimes the points of control haven't moved up as much as possible. It's never going to be perfect. What I said yesterday is there's always a tremendous amount of information out there that will be in conflict to what is really going on in the market. And that's really where the opportunity comes from, is from that conflicting information. The first example we have here, we start with the gap on 8/18. The market gaps higher, and that always gets our attention. A gap signifies a change of opinion. So if the market gaps higher and fails and comes back in, then it tells you that the market attempted to change opinions, but nothing has changed, or maybe it's even more evidence that the market was weak. For example, if it gaps higher, comes down and fills the gap, and then starts to trade lower. In the case we're looking at, the market gapped higher, it held the gap. On a short term, remember, we are talking on a short-term basis now, 3 to 5, maybe 10 days. So the gap holds. On day one, you see that the market is fairly elongated. It flattened out near the top, and you've got somewhat of a P formation up there. But notice that you don't have any completion on the high. And completion is another topic, another slide that we're going to talk about down the road. But poor highs, poor lows are lack of completion of the current auction. The following day, we get overlapping to higher value. It's a little tricky because you have the point of control is about halfway, about in the center of the profile. So that gives me a little bit of caution. But I have the gap. The short-term trend is up. Then I come in on the following day, and you see once again the market is higher. Value is higher again. Notice that the market in the morning came down to just 2 ticks above unchanged from the previous day. When I see things like that and it goes up, it tells me I still have confidence, but it's an indication to me when it's so mechanical like that. It's an indication to me that this short-term auction may be getting tired, and it may be time for it to take a little bit of a breather. But that's an idea of confidence. So I have a gap. I look here, value is overlapping to higher. The following day, I get a counter auction. To the market that we've been looking at. Notice I said on this day when you were just a single tick above unchanged, or 2 ticks above unchanged when the market rallied, that's a fairly mechanical response. And that gives me an idea that, you know, it's responsive buyers. They're buying as close to unchanged from the previous day as it can get. Gives me an idea that the market may be getting a little tired. We get a corrective day on the following day. Notice the B period, there's the A period, goes up to B, does not take out the high the previous day. Then the market sells off down in C and D period. But notice the net effect. The net effect, you had a corrective day that allowed inventory to come back into balance a bit. But on that corrective day, where the high was made, you know, in the second period of the day, it was not a good high. Record, it was not a good high. So there's really no sign of completion. Notice that even on the corrective day, value was overlapping to lower. So it wasn't clearly lower, overlapping to lower, and not a sign of a real correction. And of course, then the market gaps higher the following day, and the market continues upward. So is that a perfect sign of high confidence? No, it's not. But it's for a short-term auction, the short-term auction has confidence in it, and you don't want to be over anxious to fade that auction. Now, that doesn't mean that we aren't going to start recording. We have a prominent point of control here that has not been revisited. We get some up here. So the auction's tiring. The auction is tiring. There's some information we have to carry forward, and later on it does come back through here. But again, I just wanted to give you an idea of what confidence looks like with a short-term auction. Recently, we had confidence, a short-term auction. This is an example of low confidence. We talked about this yesterday. The market on the 22nd, the market broke below a 2-day low, which was established last Friday and Saturday. When you notice the break, you got a liquidating break, as evidenced by the B formation. So what does it tell me? It tells me that I had liquidation from existing positions, but I didn't see any evidence of longer-term selling coming into the market. Had I had a combination of liquidation and longer-term money coming into the market on the sell side or short side, I would have gotten more elongation. When we're looking at this and you see this B formation and you see a prominent point of control or a very prominent point of control, this can be very misleading to a lot of traders. Once they see the B formation, they have a tendency to want to go long immediately. It is a sign of liquidation, but it doesn't necessarily mean that the liquidation is completed. It's the same thing when you see a P formation sometimes. So now, the following day, we see the market does go back up and revisit the point of control, but the market sells off again. This is low confidence because of the B formation and because of the very prominent point of control. The following day, the market goes up past the point of control. It goes a single tick above the overnight low, or the overnight high, and it sells off again with a spike late in the day. Notice that the point of control really didn't migrate substantially lower when you had selling throughout the day. So we have a sign of low confidence up on the 22nd because of the shape and the very prominent point of control. We have a similar indication on the 23rd because the market was off a big break late in the day and the point of control stayed relatively high. So it's indications that the confidence on the downside is not high. Does that mean that you want to fade the market and go long? No. It does mean that you ought to be lightening up any long positions, or I'm sorry, lightening up any short positions you have. And the reason you want to lighten up those short positions is because the risk-reward has changed considerably because of the low confidence. And of course, then we know we came in yesterday. We looked down below that low, or what we saw at low confidence, and then the market rallied in a short covering rally throughout most of the day. Now, while we're here, it wasn't part of what we were going to talk about, but a lot of times when a market gets too short, it has to rally again before it breaks. And we'll come back to that, but this is a short covering rally yesterday. What I wrote last night, this thing was spread out over 3 separate distributions. There was nothing significant on the volume. The volume was 3.3, which is really not very high relative to the range and, you know, taking out all of the range for the previous day and well up into the range of the 22nd. So it was a short covering rally. When you get those distributions like that, and the volume was only 3.3, it's an indication that it's old business or short covering. Again, we don't have any evidence that we have any longer-term money on the buy side on yesterday. So we've looked at an example of high confidence on the upside and low confidence on the break from the point of view of a short-term auction. The short-term auction, the process of a market getting too short. This is, I use the word exponential fairly often. Historically, the first time I ever used it was in relationship to a series of poor highs or poor lows. The first time we used it, we were talking about a situation where the market had 2 back-to-back poor highs or 2 back-to-back poor lows. So let's say if we had 2 back-to-back poor lows, the example was if we had a point count, which we don't, but if we have a point count, we would say maybe the one poor low would get a -5. In other words, there's no completion to that auction, and it's not a particularly good sign that the auction to the downside is over. If we then get the next day with a poor low, we say we now have two back-to-back poor lows, and we would say if the first auction got a -5, now that you've got two back-to-back poor lows, the second auction or the second low might not be a -5, it might be a -25, for example. In other words, it's an exponential increase. It's a drastic increase when you have multiple poor lows. That same concept can be carried forward when we're talking about prominent points of control, very prominent points of control, and prominent points of control. In the case we're looking at where the market's going down, but you're not getting elongation, you're getting the prominent, very prominent point of control. So each time you get one of those prominent or very prominent points of control stacking up on top of the other, that is another sign of exponential information in there. Now, that's not an absolute concept. It's not, I mean, it doesn't give you absolute clarity of where you get long and where you get short, but it does, that kind of thinking will help you mentally readjust what you think the odds are of the market going higher or lower from that particular point of view. Okay, let me stop. Let me go back. Let me stop right here, Julia. Let's just take questions on what we've talked about up to this point.
Okay, thank you, Jim. You know, can I ask a question about the gaps while we're here? Because there's not a lot of questions. People are just listening.
Okay.
I got a couple of comments, but what's interesting and sometimes confusing to me is that overnight inventory tends to be viewed as, quote, weaker hands and is oftentimes corrected early in the session. But a gap in a day session chart's high confidence has to come from overnight inventory. I just said it's true, but you know, the only difference is that on a gap day when the larger traders enter the pit session, they decide they want to move the market in the direction of the gap, so they take it further. It doesn't have to correct.
Remember, we said that when you look at the market, you'll see about 65% of the time you get a counter auction relative to overnight inventory. So as a generalization, we say that normally the trading that takes place overnight is trading that's conducted by weaker hands traders. And the reason for that is that larger traders have a terrible time getting filled in size overnight. In other words, if the market was 10, for example, and they had a big order, they might get filled at 10, 11, 12, 13, 14, 15 because it's so thin. And larger money gets very upset. They don't like to deal in markets where the markets are very thin and they can't get in and out easily, and liquidity to them is being able to get in or out, you know, reasonably close to what the last price was. But remember, that's a generalization. From time to time, there will be more serious money because they think the opportunity is so great that more money will come in a more serious side overnight. So, for example, we said if a market gaps higher, and we've said the smaller the gap, the greater the odds that the gap can get filled. And we've said the bigger the odds, the smaller the odds that the bigger the gap, the smaller the odds that the gap will be filled. First of all, when the bigger the gap, let's say that the gap to the upside, the bigger the gap, the more distortion there is from people's trades. Too many people have gotten caught short, more margin calls. When you gap higher a long way, you've caught a lot of people short, and they have to cover to meet their margin calls, etc. So That happens. But there are some times when there's just a lot going on, and the traders are more willing, because they think there's something significant, they are more willing to be aggressive and not get as good a pricing as they would normally get overnight, but they want in badly enough. When you see that, then you've got a pretty good indication. You've got a pretty good indication the market's going to be pretty weak or pretty strong. Let's take today as an example. Let me go back. We didn't gap today. We didn't gap, but I want to go to the real market. Okay, and remember what we had yesterday. We had 3 distributions. With 3 distributions, market was very, very strung out. Let me go, if you look at the, I don't have the bar chart up here, but if you look coming into that, we really had no meaningful excess on the lows. This low is at 1969.50. Yesterday's low, 1970.50. She had no real excess on the low down there. But the morning, we come in this morning, and overnight inventory is short. As we get closer to the opening this morning, they're trading down below the upper distribution from yesterday. And remember, we said we treat each distribution as a separate day or auction. So the market is, in a sense, it's a downward gap relative to the upper distribution. Is it a perfect gap the way we normally talk about them? No, but it is a lower gap relative to yesterday's upper distribution. And you see what happened. So in that case, there was no correction to overnight inventory. There was things they wanted to do, and they wanted to do it early, and some were chasing the market early on. Now, and those things happen, but think of today as a gap also. It's not the traditional way to think of it, but think of it today as a gap also, because it's relative to the upper distribution. We have talked before about the fact that we treat each day as each distribution as a separate auction. Julia, additional questions, comments?
Yes, to clarify, Jim's definition of a gap is different than many technical definitions. It's from the high of the prior day for an upside gap, the range high, not the settle or the close or unchanged, and on a downside gap it would be from the low of the prior day's pit session range, from 9:30 New York to 4:15 New York time for your profile. I pay no attention to what happens relative to last night's settlement. My opinion is the settlement or the last price in the previous day is pretty much of an arbitrary event. Yes, okay, thank you, Jim. And we have some questions about the 45-degree line. Can Jim talk about its importance? I see they are not really 45 degrees. They are formed by a progression of higher lows or lower highs on the top, higher lows on the bottom as the profile widens out toward the middle. Why are they important?
Here's a 45-degree line right here. And if you draw
Monday,
a line, Monday,
22nd.
If you draw a line from the J period low up to the very prominent point of control, you will see that it looks like about a 45-degree angle. Now, what is the other word we have for point of control? The word I prefer to use for point of control is the fairest price at which business is being conducted. So when you look at this and the point of control stays up here and price keeps coming down here and rallies, what this tells me is that people are selling, traders are selling short in the hole, or they're constantly selling short below the fairest price for the day. That's the definition of being short in the hole. You're shorting below value. So you've got the 45-degree line here, and you have a very similar situation. It's not as neat, but if you take that last break on Tuesday, you see you've got about a 45-degree line here also, and like one more time, traders were selling short in the hole, or selling short at prices below the fairest price for the day. And so now you get a couple of these, and it starts to get cumulative. And that's, I think, what led to yesterday's short covering rally. And that's kind of, that's the importance. There's what we have talked about, and we're trying to help you understand markets in terms of the behavior of the people you compete against versus via numbers and stochastics and moving averages and things of that nature. When I look here, and we've seen it twice in a row now, we've seen the short-term traders get caught the wrong way two weeks in a row, and they got caught too short. We're going to see the slide again where we had those multiple poor highs. The market rallied up to new highs. They got them too short again the first part of this week, and you had a short covering rally yesterday. So there's you're constantly trying to figure out, is the market too long or too short? And one of the ways you do that is by asking yourself, what was the behavior? Were they, if they're too short, you're selling in the hole or you're selling below fair value. The more consistently you do that, the greater the odds that the inventory is really building up on the short side. Okay, additional questions?
Okay, great. Jim, really quickly, a poor low or a poor high. He's just found the webinars and he's curious. Like yesterday is an example of a poor high. Only one tick on the top. We'd like to have 2 TPO or 2 ticks, single prints on the top for a profile, quote, good high. Anything less, like we have 1 tick or no ticks, too wide at the top, it's a, quote, poor high or unsecured high. I hope that answers.
Well, that's the technical definition. Let's go a little further. Well, it usually an indication of an auction that is not completed. Now, one of the things that I have said to people, and there's a difference between the first mind over markets and the updated edition I did a couple of years ago. When I first started trading, it cost me a lot of money because I learned about buying tails and selling tails. And I wanted to be able to lean on those buying and selling tails. It was nice and mechanical and neat. It took me a long time to begin to appreciate sometimes when you don't have a good high or good low, what it means. For example, if you get a market sometimes that gets too long in the day time frame, you may get a poor high. And just because the market got too long. So that poor high can be a negative on the short term. However, it is a positive when you start to extend out the time frames. Now, and we're going to see this again in a little while here because we've got another slide. It's one data point. The problem so many times is people have a tendency to they want to take one piece of information and act on it. And so many times it's not quite that simple. And when you have one poor high, it's one data point. So maybe it gets a +5, meaning the market can go back through there. Now, 2 poor highs back to back, or 2 poor highs out of 3, or something like that. Now that also starts to get that exponential, indication that the market, now it's 2 data points that are poor highs. Now that's a more positive. It's telling you that it's a little more positive because there's no completion from the current auctions. So you've got, it's tricky because in one sense it may be the poor high just because it's on the day time frame the market got too long, or poor low because it got too short. However, it is not a negative consideration for the next longer time frame. And we'll see more about that. I know that can be confusing, but that's the best I can do, and it's in. I covered that in the second edition in an additional chapter to it.
Great. Okay, Jim, thank you. Today we had an open and drive. You know, we went down, high confidence, elongation, more than short-term traders. We broke the range of the previous days. Can you now say with confidence that a lower auction has restarted?
Number one, I don't know that question. Somebody made the comment, or whoever said that we had longer time frame. More than somebody, I think the thing was more than short term. I don't necessarily think that's true. The volume on the first half hour was not particularly high. I think what you had is you had a liquidating break in here this morning. The market got too long yesterday. You had early this morning. You were up several handles on the dollar. The dollar index is what I follow. I think you had a knee-jerk reaction, and the dollar index being high, that has a tendency to have, over the long term, a strong dollar over the long term is usually consistent with a strong stock market. As I have pointed out on several occasions, fast, sudden moves and spikes in anything, whether it be bonds, whether it be gold, crude oil, the dollar, can have a negative effect. The market doesn't like uncertainty. So what happened, I've been sending out charts for some time here showing that the dollar index was up around, and it was slightly above the 2013 high. 2013 high. I'm trying to make myself younger. And then once
do you have your
above,
CQG, Jim? I beg your pardon.
No, I don't. I can load it.
Maybe that wouldn't be just what in the future we might need it or can go to it.
I'm closing the other machine I've got it on. I'll bring it up here.
Okay, thanks.
And then we went just a couple of ticks above that the 2013 high. I think it was only like 2 ticks or something like that. So again, let's go back to this. The two most important concepts we deal with are excess and balance. You've heard that multiple times. Excess marks the completion of one auction and the beginning of a new auction. If you take the long term going back to 2010, the 2013 and 2014 highs were very similar with only a couple of ticks difference. Then you had a big breakthrough the last couple of days, and you broke clearly above that early this morning. And I think I'm going to bring up CQG here. I think what you saw, or what contributed to part of this break this morning, was a knee-jerk reaction to highs going back to 2010 in the dollar. The market sometimes doesn't adjust well to that, and particularly the short-term traders. The longer-term money, it may be ho-hum to them. The short-term traders have a tendency to get knee-jerk reactions to things like that very rapidly. Okay, so here's, bring up the bar chart. Okay, there's the monthly bar on the dollar index. And you can see what it's done. This is July of 1910. We're now back up to where we were, in 2010. And I think that's a knee-jerk reaction, I think, is part of the reason for the selling this morning. A stronger dollar can be a difficult situation for a country because it makes their goods less competitive. Now, over the longer term basis, when your economy is strong, people are buying this because people are buying your goods and they have to use dollars to do that. But on a short term basis, you can get that knee-jerk reaction. Okay, let's go back. Let's go back to the slides. Do we have additional questions before I go on?
Yes, Jim. Thank you. Structurally, the overnight inventory certainly appeared to be short. However, could you have viewed that structure from a logic, quote, perspective and seen that overnight action as overnight traders buying pullbacks and that today's break at the open was a liquidation break? Does logic have more importance than structure?
I don't. Are we talking about the overnight inventory?
Yeah, you could parse data till he's saying they're buying pullbacks and it's just they're weakened. You never know what they're doing overnight. It's so hard to tell.
There's so little volume that goes on. The range was fairly small. You didn't see the sell-off come in. The sell-off started to come in about an hour or so before we opened in the U.S. If you look at the morning report I put out this morning, when I first did the report, I had I've drawn all the charts and put the last trade as of 8:34 Eastern Time. Then I added later an update. In the update, I said, appointed a different time to show you that there was selling. That's why it was updated. It was selling prior to the opening in the overnight or electronic market, and that's not uncommon. Now, that isn't always meaningful. Sometimes we see them trapped. Hold on, let me show you the market here. And sometimes, let me see, Julia, do I have overnight on? No, I don't. Julia, can you bring up your machine?
Yeah.
Yesterday, I think was an example. They were selling, or maybe it was the day before. There are some examples where the market selling off, coming into the opening, and all of a sudden, once it opens, it's gone in the opposite direction. We had one of those recently. Let me see if it's. Hold on.
Hold on, Jim. I can show you.
No,
I just put it.
It's on one of these charts.
Yeah, but it's right here on my screen here. So if you want to just talk about it, because if you go to the white chart, it's harder to see with your overnight. Can you see my chart now? You just click on the flower on your taskbar.
Okay. Okay, let me see. It's not. I don't see it right away. I remember one distinctly the other day. Move it up a little bit so I can.
Okay.
Hold on here. Just. Oops.
Monday night, Tuesday night, Wednesday, Sunday night. What are you trying to?
I don't know. There was a time when the market was selling off in the overnight and coming into the opening, and it just turned right around. Overnight inventory was 100% short.
Oh, okay. It was.
It went right
yes,
up.
yes. That's. It's a Sunday night. It opened really far down, and it spent all night going up. And you had said technically it is all short and below the settle.
Okay. All right. Let me go back.
Okay. Let me show you screen.
Yes, I'm sorry. Let me know.
It should be. Okay, mine's showing that overnight now if you ever want to come back to it. Okay. Can I ask okay, whenever you're ready. If you're having an audio issue right now, most people aren't, but if it's breaking up for you, it probably is your internet. because I haven't heard Jim's voice break up. And there's been 3 people that have said that. You might help to sign out and sign back in. I'm sorry I can't offer a better solution, but that's probably what it is. You had said earlier, Jim, there's no excess on the low. Are you referring to the excess on the weekly lows now that you have your CQG up on the S&Ps? And then we have another Globex question and opening range.
If you look, that low is 1970.70. This low was 1970.50, yesterday's low. I think this was on last night's, I'm pretty sure. Let me go to the chart. I think we've got the chart here.
Yeah, last night's report is in there for the daily. Just move your GoToWebinar too, Jim. It activated and it's on your screen. Just close it. Thanks.
Okay. Here's last night's, and this is kind of what why I'm feeling a little silly this morning. I looked at it.
Right, you wrote it up. Yeah.
I wrote it up. I was looking at. Not only did I wrote no excess. I marked the prices, and what I did this morning is I just let myself mentally go to sleep. You know, I said earlier this morning, I was not anxious. I wasn't going to be in any hurry to make a trade this morning. I saw we're going to open below the upper distribution. I thought the market would probably churn around for a little bit this morning. Even though I saw what was going on the overnight, I saw the dollar index. I just was asleep at the switch. And when the market came back up, it gave you 1 second chance to get short this morning. The market came back up to 1 tick below the opening, or exactly at the opening, and it just died there. And when it died there, I was in the process. I said, "Oh boy, I need to do something here, get some puts." And by the time I brought the expiration up, I decided not to chase it. And of course, that was a bad decision. But the point was, when you're doing your homework, I should have been better prepared, because I wrote there was no excess on the low. Additionally, let's go back to the weekly. Going to CQG. It's another thing that's embarrassing, because we have, this is tremendously embarrassing. If you'll remember, we have been using the reference 1975 as, and hold on, now, I've got to make sure this is on December, only the December contract, okay? Using just the December contract, this high was 1975. We have been using the 1975 high to differentiate between the lower and upper distribution. I have said that the market was, you know, this is when these start to overlap, it's a sign that the auction has aged considerably. Doesn't mean it's over. Then when you go to the next step and say there was no excess on the daily, I should have been far more attuned to this potential. So what you're seeing is you're seeing a confession of somebody that just simply dropped the ball and probably got a little mesmerized by the short covering rally yesterday, even though intellectually I know that can weaken a market. It just caught me off guard. I've been watching the dollar. And that's one of the things that's so important that we say is the importance of doing your own work. And when you first start out, you know, you rely on somebody like myself that's doing it. As you get more and more experience, you should get to the point where you say, you know, I think Dalton missed it, or you start questioning and say, I just don't believe it. And you know, because I am going to be wrong from time to time. I'm going to miss things. I can get too complacent. But the information was here, and once the market started down, part of my weakness is I have a terrible time chasing markets. Once the market started down this morning, I should have just chased it. I was waiting for a bounce. I was ready to get involved on any decent bounce, and it never gave me one that that satisfied me. But anyhow, enough of all of that. The information was there. There's the weekly. We just looked at the daily. There was no excess on the daily, 0.20 when you're looking at the large contract. The information was there. Okay, Julia, let's go back to the slides.
Can we ask one more question, or can I just tack on a question?
Please.
Benjamin is just asking, you've made this comment before, haven't mentioned it yet today, but it makes sense for what happened today, that sometimes you say that sometimes a market needs to break before it can rally. It clears out the weak hands, moves over to stronger hands traders, and then they rally it up again. Well, it seems to him today the opposite happened, that sometimes a market needs to rally and make the shorts cover the weaker shorts before it can break again. Do you see that as a possibility?
Absolutely. And that's something I say all the time. And I think that's exactly what happened yesterday. The market was too short. We saw it got too short. It was too short to go any lower. The market had to rally the break, and then you got the catalyst of some other stuff going on at the same time, and the market went down and took out that non-excess low. But no, I think that's absolutely, and it's something that I say all the time. And remember, a short covering rally weakens a market, and it weakens a market because it removes the potential buying power. Anybody that's short has to buy to cover. So if a market gets too short, sometimes it's difficult to take it too low because every time it starts to break, the shorts are covering. Once you go like yesterday and you took all those shorts out of that market. So remember yesterday, not only did you take all the shorts out of the market, but at the same time, I'm sure that you got short-term traders on the long side. You got short-term traders on the long side of that market also. So you got a combination that you removed the shorts and you added weak longs to the equation. Okay, are we ready to go on?
Yes, we have some. Can I make one comment about overnight inventory before we go on, and also mention, Jim, there's another slide that's more detailed beyond this slide, okay? I've always suspected that sometimes strong directional moves in the Globex trading could be deep pockets, short-term or longer-term traders using thin overnight market conditions to game the real-time pit session open. Do you agree?
Not particularly. And when I say it depends on the term deep pockets. If we're talking about deep pockets, it's like, as I say, short-term money has some very deep pockets. I just want to make sure that's differentiated between, the longer term and intermediate term money. It's very doubtful to me that the longer term and intermediate term money gets involved in the overnight market. As you know, sometimes it's, other than the last 2 hours at night and the first 2 hours in the morning, it's pretty hard to get any volume on trading stocks overnight. And most of these people deal in stocks. But the short-term time frame does have some pretty deep pockets. So if you're talking about the short term, I think it's entirely possible that the short-term time frame would do things like this to game the market. For example, I think they did it last Thursday evening. We had the expiration coming up on Friday morning for triple witch, and I think some of those deeper pockets in the short-term money, I think they gamed the market and squeezed the people who are going to be involved in the expiration. So that stuff does go on. It's very possible that the shorter-term money today could sense that because of the big rise in the dollar this morning, they knew that was going to spook the market, and they came in and they got an early start on it. I think that's entirely possible. Remember, these people they have a lot of money, and particularly when the markets are thin. This is a classic day to game a market. It's a Jewish holiday. The markets more than likely there's going to be a lot of traders that aren't around, and anytime you've got a thin market environment, you've got to be very careful. Okay. Should I go on, or do we have something lingering out there before I go on?
Well, thank you, Jim. The opening range, how do you define it, or do you even use an opening range?
No, I do not use an opening range. I just simply take the opening price and that's given to me on my quote vendor, and look to see how the market reacts relative to that open. Is there confidence? Is there high confidence or low confidence surrounding that opening?
Jim,
today was a high confidence.
Okay, I beg your pardon. Today we stopped 3 ticks above the gap from August 18th. Would large time frame traders stop at that level?
Sure. You'll find that. Hold on. Let me. And that's another thing, because I'd also written about that as being very dangerous and very thin down there. Okay, we have some difference on prices, but I had, if we go I think the gaps on the profile was electronic were a little different than the gaps I show on the CQG. I had the gap at 1965. I think the profiles had the gap at what, 1963 or so, 1963.50. Let's go back to the
60. It was 63 in the mini for the gap, high of the gap, and 61 for the low of the gap using the front month D's.
Okay, so it's, in this area marked as a very thin area, and when you get a reference area like this, the low today is what, 1962, and Julia, bring up your profiles and see on.
I can show it there here if you want. I can just.
Okay. On 19 August, see what the low is on the profile.
Yep. All right. Here we are. Can you see my screen? The low, the gap high is 63 and the low is 61. This was August 18th going to Tuesday.
Sorry, I'm not seeing your screen. I'm sorry.
Are you clicking the flower on the task panel to make sure that screen is active?
Okay.
You see it?
Yeah. What is it? It's at, okay, and today's low is at?
Let's go over there. Sorry about this, I didn't expect it. Yeah. Today we're just,
almost in the gap.
We got 2 ticks.
Yeah.
3 ticks.
Yeah. And that's, and that's another thing that just drives me nuts this morning, that I wasn't prepared, because those are the destiny. When you get a market that starts to go like today, it's going for those references. That's where it's headed. And when something like this goes, you look very quickly to see what are the visual levels that the market is likely headed for. And like I say, I'll quit carrying on, but I was sitting there getting prepared for this, and I was just not mentally there, and that will kill you as a trader. That is really kill you. What you don't want to do, it's one thing to miss it. You don't want to get angry, and you don't want to fade it. That's the real killer. So I only did part of it wrong. Okay. So it goes to when you get a break like today, very dynamic, it goes to very visual levels, and the embarrassing thing, it's not levels we hadn't pre-identified. We pre-identified there was no excess on the lows. We had pre-identified this was a very low volume level, and the market was likely to trade back into that, and of course that is exactly what has occurred. Okay, I want to go back to the slides. If you will give me give me control back.
Jim, hold on. Here you go. With excess over the 68/70 range, would you consider this, or finds acceptance and accelerates? I'm not sure I'm following. I don't know if there's excess. Is there excess? I'm not sure I'm understanding that.
I don't know. Let's go back to our purpose today was to get
Just
ready
do
for
from current slide. Yeah, you can do from current slide, Jim, up there.
Okay, I'm sorry.
It's no big deal. Just you wouldn't have to just start from the current and you'll be fine.
What was the last slide? Okay, high confidence. Okay, day time frame conference measured in two ways. And we start off measuring it from the opening. And, you know, if I'm back and forth through the opening, it's an indication that confidence is low. Today, we were not back and forth through the opening. The confidence was high. We then go and we look to see developing value is the second level. We're looking at day time frame confidence. Is value developing higher, lower, unchanged? And those kind of things give us a different view of confidence on a day time frame basis. Overall, you want to, particularly if you're a newer trader, you want to focus very heavily on value, on developing value, and you want to trade with that developing value. That is probably the biggest thing that will save you and help you be profitable early on. And remember, and we'll talk later, but anytime you fade developing value, you have to be right very quickly. So the confidence around the opening, then we look to see where is value developing. So that's two ways we look at confidence on the day time frame. The third way is, and this is trickier, it's how the market behaves around static references. For example, we saw yesterday, we saw the market sold off from one ticker exactly at the overnight high. When a market reacts exactly at a reference point, even though it's sold off hard, it looked like high confidence. That is not a sign of high confidence because it's responsive selling. The market was responding to a pre-identified static reference. So they were only acting in a responsive manner. Responsive activity, meaning responding only to an advertised opportunity. The advertised opportunity was the overnight high. When markets are reacting only to an advertised opportunity, that is not nearly as strong a reaction as when you get something that would be stronger, when it's initiating. For example, if they're going to sell markets, when they start to sell the market today below yesterday's low, that is initiating action. They're selling it at 6 when they could have sold it at 10, all day. That's initiating. That's much stronger type of action. So when I look at when markets react exactly at a reference, that is usually a sign to me of low confidence. So for example, if a market goes down and it stops exactly at unchanged and then bounces, that is not a strong reference to me. If it went clearly through unchanged and came back through it, that would be a much higher quality reference to me that when it bounces, or retreats from an exact reference point. Again, I use these type of things to get inside the head of the people that I'm constantly competing against. Is there any questions on what I just said about the use of those references? And it's important. And there may be a good day time frame reference. The market goes to unchanged, maybe a good day time frame reference. But the odds of upside continuation are lower because it was an absolute, visible, easily identifiable reference. And that's when they go to mechanical, that's usually a sign of weaker time frames, shorter term traders. questions on that?
No, not on that, Jim.
Okay.
Where do you get the 30-minute volume? Sue, it's at the training site. It's at the JD member site on the dashboard. But you can go to Yahoo Finance, and the hat symbol above the 6 key, T as in Tango, V Victor, dot N Nancy, TVN. It's available at the Yahoo. Just put it right in this Yahoo search.
Okay. All right, I'm going to go to the next slide.
What is the target now that we are below 1975? The August low. We talked about the gap.
I'm not there right now. My mind, I haven't looked at it. I'm sitting here working on the slides right now.
Okay, sir.
I'm sorry. When I do the report tonight, down there. Okay. Here's a confidence day time frame example of high confidence. The market gaps open and holds the gap. Remember, a gap is an indication of a change in it's an acceleration or an change of what has been occurring. And you can see the gap, the market gapped higher, and it did not close the gap, and it went directly higher. That's day time frame high confidence. When you have that kind of high confidence, it is rarely given back on that day. Can it happen? Yes, but it's a much rarer occurrence. And as you see, this market went up. We look here, it went up very quickly at one time frame for A, B, C, D, E, F, G period, and then you've got some, you got a little balance late in the day. But there's no completion to the auction itself. But on a day time frame basis, it was a high confidence auction. Okay. You've seen this slide before, or at least portions of it. We say to trade with value. The best advice I can give to any new trader, if you're an older trader and you're profitable and you're really comfortable with what you're doing, then you don't need to pay a lot of attention to this because you've already figured out how to navigate around it. But if you're not profitable, no matter how long you've been trading, or you're relatively new to the process, you can bring the odds in your favor by trading with value. And what you want to do, let's say, for example, that value is lower. You want to be selling rallies and taking profits on breaks. I'm very careful to say, and this is where people get messed up sometimes. I didn't say buy on breaks. If value is lower, I want to sell rallies and I want to buy back or cover on breaks. That's a much better strategy. When you try to trade the market both from a long side and a short side, it's very hard to keep a perspective on what is really going on in the marketplace. If you set up that you want to market values building lower, that you want to sell rallies by breaks. Now, the problem, everybody always comes back and says, well, I did that on Wednesday and boy, that didn't work. Well, guess what? It's not always going to work. So what we're trying to say is, what are some of the exceptions to trading with value? Okay, we saw one yesterday morning. It appeared that value was going to be developing lower. The market looked outside of the previous day's range, came back in, looked out one more time, came back in. When a market looks outside of balance and comes back in, we know that has the potential to be a large opportunity. So and when you get that happen, that's an exception to trading with value. Another exception would just say the market is lower and all of a sudden you get a new low and the market leaves an excess low and it then starts to one time frame higher. You want to be aware of that. And this is why I always suggest you start a new profile anytime there is a new high or low which it's got excess on it, that you see if in fact something has changed. So I keep the profile split out and I start a new profile at any new high or low that has any excess associated with it, meaning a buying or a selling tail. If it doesn't start the one time frame from there, then I just mesh them all back together and say I'm in a balance or rotational days. Another thing that's okay to do, if you've got a, let's say, developing value that's lower or higher, either case, if in fact you get a couple of inside bars that show you short-term balance, okay, it's okay to attempt to do the trade if that market comes out of the short-term balance. Those are usually good day time frame trades. The better trade is if the direction is to the downside, and if the short-term balance occurs on a rally, you know, it's better to trade the break to the downside that's with the move. But it's also okay to trade a break outside of two bar balance to the upside, because it's an asymmetric opportunity. You put your stop, you put your buy a couple of ticks above the two bar balance, put your stop a few ticks back in. It's a legitimate day time frame trade. I prefer to do that trade when it's with the direction of the developing value, and if I'm going to do that trade, I want to make sure that there's no really wide prominent points of control on the profile that are going to make it more difficult to move substantially away from that. And remember, anytime you fade value, you must be right very quickly. It's very dangerous. The most dangerous trade you can do is fade value, and if you fade value and it gets away from you, it can be very disastrous. And today was just a great example of that. You know, one of the worst things we said you can do is fade a trend day. Today was a great example. Anybody that faded the trend day today or faded developing value today just got their socks knocked off. It's one of the worst things a trader can ever do, is to fade a trend day and fade developing value. Now everybody says, well, I did that the other day and it worked. If you do it over 1,000 times, I think you're going to find that the odds are very much against you. It's just not something you really want to do. Okay. We talked earlier about exponential information. And we talked about it in terms of, we started off explaining, I used to talk about it in terms of back-to-back poor highs and lows, but it also happens with any other data. You know, a series of very prominent point of control that's left above a current market, it has the same effect. The one we show here, which you've seen before, was we had the multiple poor highs. The market was going down, and that's why I said the short-term traders have gotten caught the wrong way a couple of times. We had the multiple poor highs. Market looked like it was pretty weak. It went down below the 1975 reference we've been using. And then, of course, in very short order, the market rallies, takes all of those back out. Again, that's a great example of exponential information. Okay, and you've seen that slide numerous times before. Completion, we briefly talked about this. When you saw those three poor highs you just looked at there, one of those poor highs was at the all-time session high. When you look at those, none of those were completed. In other words, those auctions were not completed. This is relative to the day time frame, the short-term, as well as the long-term auction. The principles that we talk about are the same for any time frame, whether it be day time frame, short-term, or long-term. The principles are the same. So this idea of completion. Now, and sometimes completion can be delayed. For example, now the market looks really heavy on the downside today and it looks really weak. But, you know, we've said it's unusual that the long-term auction would terminate in the over-the-counter market, and the all-time high right now was made in the over-the-counter market. It'd be very unusual for that to last, but I've also said you can get meaningful liquidation breaks, with that high, but it's usually not lasting. So right now the market's going in a liquidation phase. In here we're seeing some fairly serious liquidation, but more than likely you want to carry forward. The chances are pretty good it's setting up for a healthier rally down the road that comes back to and through the all-time high. So in other words, there is no real excess, the way I look at the market, relative to the high being made in the overnight market. If we go and look at it in the pit session, we do have an excess high in the pit session. I believe it's I believe this is the overnight high. We do have an excess high in the pit session, so it can last. There's nothing that says it can't last. We're now getting a liquidation break, in the market, and but that more than likely, my guess is going to be that we're seeing liquidation, and when the liquidation is over, it's removed. It's the same concept that Benjamin brought up before. Sometimes a market has to break before it can rally, and that can be applicable to any time frame. We see it in the day time frame. The same thing can happen in the short-term time frame as well as the intermediate time frame. But sometimes you get too many weak holders of even the longer time frame, and they have to be replaced before the market can do something substantial on the upside again. So excess is the clearest way to indicate that we have an excess high. It's the clearest indication. Happens the day time frame, short or long term. Okay, any questions before I go to the next slide?
Thank you, Jim. In terms of using that overview to analyze the market going forward, if we were to get a close today with excess above the 68 to 70 level, would you consider that a look below balance and fail if you were looking at a daily or even the profiles? If we closed up there at the 68, 70 level?
It's not where it closes. I'd have to see I'd actually want to see what the low looked like. Did I really get rejection off of it? I looked, for example, early this morning. Let me show you what I was looking at early this morning. Okay. We broke, if I remember this right, we broke in C period. C period rallied back up and just barely got back within yesterday's range. And at that point in time, all of this would have been single prints. So I watched up here and I said, okay, if I start to build anything above the C period high, then I have a chance that I had excess today. But there was no follow through to the upside. We got in a couple of ticks, and then of course then the market started to trade lower. So I said, no, it doesn't look like it. Now, let's say that today, we left this down here and we closed, say we closed back, well back into yesterday's range. Yeah, I could say that. I could see that as potential excess, because remember, but it's not quality. It wouldn't be quality excess. Quality excess would happen fairly quickly. The market really drove down there, and it came out pretty fast, pretty strong, and you saw some pretty good continuation as the day went on. if we came out of here, we could have short-term excess, but I don't think it would be terribly lasting. But remember, we are in one of the lowest confidence markets I have seen in some period of time. We do not have, I don't think the high is any good on the long-term market. We had no excess on yesterday's high. It looks to me like you got another knee-jerk reaction to the downside today. I don't trust this market in either direction. And those things happen, and it's not uncommon for them to happen in September. And remember, today is a religious holiday, and you may not have all the serious market participants active, and this can happen on thin markets. Okay. Okay, so the completion, and you're always, when you're talking about doing your homework, and sometimes you may look and it's, what happens to us sometimes, it may be 8 or 9 days back and there's no completion, and we start to forget about it. That's part of the trader's trap. You need to make note of that and carry that information forward because it can be valuable. Like today, I'm sorry to do this again, but I've been marking that low volume level for some period of time, and I've been pretty certain that we're coming back through it. Just because, and I said it did not provide good support. And of course, what do? They come back through it today, and this is the embarrassing thing from trading all the preparation in the world. If you don't execute, it can catch you off guard. But it did work. What it did, it told you that the odds weren't really good. This was not a particularly strong market. The foundation.
Could you show your profiles, Jim, just while you're talking? Thank you.
Well, it's not the profiles as much as it was the, when we were looking at that bar chart before that you had up there. Or here, we can go to mine.
No, you can. Yeah, you can just go to the bar chart. Just why I understand it.
That this was not. I've been writing. This was not good support down here. There was no real volume through there, no real volume, and there was a pretty good chance we're coming back through that, at least to check it out. And of course, it did it very suddenly on a big day to the downside, almost 30 handles. Okay. Okay, so we talked about excess, or a completion, which is the clearest thing is excess. And remember, excess and balance are the two most important concepts that we ever deal with. Okay, this is, we're going now. You've seen all these charts. You saw them yesterday. It is so important. We're going through it one more time as we wrap up today's webinar. It's how do you prepare for each day. You gain a top-down perspective. You look at the monthly bar. You're looking for long-term trends, direction of trends, age of trends. You look at the weekly bar, same thing. Remember in the weekly bar we said the trend was weakening. The trend was weakening because they were overlapping. And you're looking for, do we have counter auctions? Is the long-term auction up? We have counter auctions on the weekly auctions. You're looking for divergencies, but you start, what I'm trying to say is you start with a top-down perspective. Too many times the problems we have in trading are because we get too narrowly focused. So by starting with the top-down, going monthly, weekly, daily, and then profiles, I keep coming down to the point of getting prepared to do a trade for the following day. But it's very important that you do that preparation day after day after day. Now, right now, it doesn't take a long time to do the monthly because the monthly trend is up. Now, I'll be looking tonight to see how close we are to last month's low. That'll be an important reference in here. But it's the habit. What I'm getting at here is the habit. We've said it before. It's like the Patriots quarterback. Look at game films over and over and over. It's boring. It's tedious. Good successful trading is boring and tedious, because the work is not, doing the homework is not fun for some of us. It takes time. You say, I can't do it. I got to take the kids to the soccer game. I got to go do that. If you've got those things, if you continually find those excuses not to do your homework, then you probably shouldn't be trading. It is so important to be prepared for each day. And what's really important is to establish the habit. If we go through, then you look at the daily bar, and you come in, you know, as we're going through this, you look at the monthly, daily, monthly, weekly, daily. You come down, and the daily bar, you know, shows no excess. So it should start to get you prepared as you come into the day. Then you go to the profiles. You go to the profiles, and we looked at yesterday, you know, we had 3 distributions, and the first thing on a short-term basis this morning was say, okay, how do we treat 3 distributions? I wrote last night, it was very strung out. Volume was 3-3, not particularly outstanding for the range of the day. We treat each day as a separate day or auction. So actually this morning we opened out of balance relative to the upper distribution from yesterday. So we come in today, the market's out of balance. So you know it's out of balance. You do that homework, and you're prepared for it. Final preparation just before the market opens. You're looking at overnight inventory. You want to know if it's long or short and to what degree. Then where are we opening relative to the prior pitch session? Are we opening in or out of balance, and to what degree? A little trickier today because I treat each day as a separate day or auction. So today we were opening out of balance relative to the upper distribution, or what I considered as a separate day or auction. So we were out of balance. Overnight inventory, you know, it's about 65% of the time there's a counter auction. The other thing we've said so many times is if overnight inventory is short, for example, and the market doesn't care, that is usually a sign that the market is weak. Let me rub that in my face that I missed it. Again, mentally wasn't there. All the signs, everything was there this morning for the short. Overnight inventory was short, the market didn't care. We opened below the upper distribution, the market is weak. We had no excess on the high. So the research was correct in there. Those are the things, and how we would execute is correct in there. That's the preparation that you go to time after time after time. When you're talking about the preparation, you know, in here, there's the one more time, there's the overnight inventory, there's the distribution we were just talking about. We know that's a reference level. The upper distribution also coming back into yesterday's range. As you know, anytime I look above or below a previous day's range and come back in, the hair on the back of my neck stands straight up. So everything was there. Everything we talk about, everything we teach was there today. Where did we open relative to prior stage range? In balance. Remember, if you're in balance, it's usually smaller opportunities. Out of balance, the opportunities are larger. And then you're looking to what degree are you in or out of balance. The key today was relative to the upper distribution, not to the whole day. Although we basically did single. The exception always is if you single print out, and it was just clear that it was very aggressive on the sell side this morning. So it's constantly going through doing the preparation. Once the market is open, we recommend that you record the short. Record it. Its value higher or lower, confidence, tempo, volume, how's it trading around references, trades you're considering, what might be coming later. If you don't do that, it's very easy to lose track of it. It's very easy to do. Guess what? I didn't do it this morning. That's a terrible violation. But clearly, the confidence was high on there. You should make a note of that. The confidence is high. The one thing you do not want to do is you do not want to fade those markets. Confidence was high on the downside. value was heading lower. We were below the upper distribution. Tempo was high. It cut right through references. It basically didn't stop at the references, and that's usually a sign that it's a very serious undertaking. Okay, trading with value and the exceptions to it. We talked about this earlier. You know, out of balance, what the market starts to one time framing. We talked about what's it mean to trade with value. If value is lower, you want to be shorting rallies and taking profits on breaks. More profile observations, just to get used to. You always want to pay attention to POCs. Do they migrate or not migrate? Are there prominent points in control and very prominent points in control? Are there spikes? Is the market elongated versus non-elongated? Trend days versus rotational days? Now, we're probably going to get a situation today where the market is too elongated. And that happens on liquidation breaks and short covering rallies. When a market is too elongated, generally speaking, it gets itself, and like today, too elongated on the downside, it generally gets itself too short. And in the next few days, you see some recovery of that. Does it have to happen? No. But usually when a market's too elongated, it's a good sign for that day. It is not particularly a positive sign going forward. You got to be very careful. You're still going to, as long as you use value, value will help you maintain that perspective. But these are just all the things that there's a lot of things to think about. And Julia used the word the other day, integration. There's a lot of things that you're constantly integrating to be a successful trader. You know, where's value building? Is there a trend today? You know, where are the reference levels? It's not easy. There's a reason that the success ratio is so low. It's very hard. One of the things we do as traders sometimes is we focus too hard on one reference instead of being able to keep a little broader perspective and asking, what is ruling reason? Today, ruling reason was the market. They were selling the market, and they were selling the market hard. The overnight inventory was short. Market didn't care. So that's an indication that the market is weak. But you keep these things in mind. Now, you know, even though right now the market's going down like crazy, but we still have to carry forward. We have a poor high from yesterday. Another indication that we're probably getting liquidation today rather than new money selling. Okay, again, we've been through those slides several times. We've said balance and excess, the two most important concepts we ever deal with. And the other fundamentals, again, daily preparation, prominent points of control, spikes, elongated. You've seen all of this before. It's just, it's the habit. You want to build those habits of doing that preparation. You do that preparation, and you always want to have 3 potential scenarios worked out ahead of time, so you don't have to think as much on your feet if things happen very suddenly. Okay, we're looking forward to it. That's, you know, that's this is the wind up for our 3rd day of preparing people for the webinar or the intensive that starts on Monday. And what we were just trying to do is give some of the newer people a little refresher course or a review of the things that we'll be looking at every day. And as you know, we do about 8 hours of online, you know, webinars like this, and then I blog throughout the day. It's a one-way blog, but I will blog throughout the day with what I see as important concepts that are coming along, or levels, or just activity, things that are of interest pertaining to the market that's trading on that particular day. So anyhow, Julia, that kind of winds up our formal presentation. Do you have any lingering questions out there?
Yes, thank you, Jim. A couple here. We now have acceptance below last week's low. Is that a reason for, quote, change to the downside?
It is.
Maybe we could look at daily bar chart or something or profiles, sure. Would you agree with his assessment?
Okay, there's the weekly bar, and remember, we've been talking about this weekly bar for a long, about, you know, the line that's the bifurcation between those two for some period of time. And we've said once you're in this clearly in this lower distribution, and we said the other day it was the first time it closed below the 1975 level, which should have been another clue. You're now down into this distribution. You're at a weekly low. You have a weekly low here of 1961.40. The weekly low today is 1960. So now you got Friday coming up tomorrow. What you're going to want to see, yes, we're in the lower distribution. The potential is to trade to the end of the lower distribution, which is the 1900 level. That's the potential we're looking at. So now what you're looking to see is, right now we're one time framing lower on a weekly basis. There's the excess high. This week took out last week. And now when we come into next week, we want to see if we can continue to one time frame lower. If we continue to one time frame lower, then that increases the odds that we trade it down to the 1900 level and another gap that's down here, 1899 to the 1900 level. But this is the potential destination trade down at the 1900 level right now. So now what you want to see, do you get downside continuation from here? And you look at the weekly chart next week to see what we get. Do we start the one time frame lower? You know, or do we get an excess low along here someplace and, you know, start to go back higher? I mean, that can always happen. If you take a look over here, you were one time framing higher on a weekly basis. You got a huge break one week that took us right down. You talk about, you know, right down to just about the level it should have been. That would have been, that was the top of the prior distribution, 1892 even.
Or even the gap, Jim, no, there? Wouldn't you take that gap as the
I'd take
reference?
The gap, but I had this as the ultimate, 1892.
Okay.
And then I had the low of the gap was 1899. You had matching highs, 1898.50. So this would be the early reference. This would be the later reference. And of course, you only got to 1900. So that you broke. You completed the drop to the base of this. And then you came back up. And once you fail at this end of the distribution, the destination trade is the opposite extreme. And then you got the opposite extreme, you broke out. Once you fail at the high here, the destination trade is to the lower end of this. You've made it. Now that you're back down below this, the destination trade is down to the low of this distribution. So that's your ultimate destination trade that you'll be looking at right now. And now you're looking for continuation. So what would show us continuation tomorrow or next week? We get acceptance back down below this 2-week low at 1961.40. This is our short-term reference right now. The 2-week low. Do we get acceptance below the 2-week low at the 1960 level? You know, 1961.40, 1960. This high is 1961. So the question is, do we get acceptance down below this 2-week low, or, you know, do we rally back up again? So that's where our focus is going to be very heavily on the 1960 level going forward. Acceptance below the 1960 level increases the odds that we make it down to the 1900 level. Rejection at the 1960 level increases the odds that we rally back. Okay, additional questions?
Yes, 2 questions about or comments about today's profile. Number 1, the short this morning, Jim. Can you explain where you could have gotten in? Bill is asking a specific or pretty specific short entry. Where would it have been and why? You mentioned the 1 tick up and the failure at the open this morning. Was that it?
Right here. When the market rallied.
Can you make that a little bigger, Jim, please?
When the market rallied back, When the market rallied back to the opening, that was the short. You know, and then like I said, I'm not a very good chaser of the markets. I kept waiting for a more substantial bounce in order to get my short out. And I never got the bounce. I never got the bounce I was looking for. And of course, you know, it sounds like I make excuses, which of course I am. You know, we were doing the last of the slides, and my mind was preparing for today, so I really wasn't 100% there. But the only easy short I saw was when the market went up to the opening, it just died. And like I say, I turned around and I was scanning the options. I should have been more prepared, and I was bringing them up on my my order entry, and the market dropped so fast. I said, well, I wasn't going to chase at that point in time. Then I waited for a bounce, and I never got a decent bounce. There was another shot right here when it came into yesterday's range and couldn't hold it. That was another potential place to short, but it was a very tough one.
Yeah.
Okay. But
Jim,
the only clear point I saw was right there, and again, you have to be mentally prepared for it. Another question.
Can you cancel that, Jim, now? Because we'll see the profile split out, and it'll be. Yes. We just had the point of control migrate, but if you push it up toward the lower where we're at now, she was saying that the bear with me. The POC hasn't migrated down in the last hour and a half, despite the market going lower. Why is that significant? And then she said, actually, it just migrated lower. Yeah. She put that in about 5 minutes later.
Yeah.
And anybody who's using Window Trader, I like to mention this because I didn't know it. If you see the gold D and E letters up there at the 1968 level, that's the dynamic point of control, meaning that before the H period started printing, Window Trader will track where was the point of control before it is now green and showing now. And you can see that was the point of control, and she was making the comment it hasn't migrated. But that's where you need to say, okay, you look at your clock. We have 2 minutes or whatever it is till we print a new TP, a new period, so we're going to have more structure added. Where am I going to visualize this point of control going? You can always be thinking ahead. What is the profile going to look like with the next 30-minute auction? That can be helpful, keeping my mind out of the present and thinking of scenarios. But do you have any comment there about the migration of the POC for today?
Now, my concern is I'm not really following the POC right now. It's not a regular day. We've had a massive liquidation. We've had a massive liquidation day, and my guess is, even though we don't have a good low down there, my guess is that this market's gotten dangerously short. You can see we've got it just so far so fast. It's just something that I probably just stay away from, and I'm not going to worry about it. But I think it's dangerously short in there, even though we've got a poor low down there, and I don't know what can happen from here. Obviously anything, and it may well not be the low for the day. It doesn't look like it. But I'm not really focused on the POC today. It's an unusual day. It's a liquidating day. And, we made this high right up in here, the BCDE. So it's been, since the E period, E, F, G, H period. It's been a long time. You're getting very little follow-through from this low, from this high, when the E period exactly matching the D period high. You're getting very little down here. And I'm guessing is the market's getting itself dangerously short. But at the same time, we don't have any indication of a good low. Remember, you can get a poor low if a market is too short. I don't know a lot more about this market right now. I know it went down to a very visible level, visual level down there. I just think it's a dangerous market. I think it went too far too fast, and I would be very cautious.
So it's interesting. Yeah, so we filled the gap, which the first time down we saw a bounce. We know this in C period. First time down to a gap usually bounces. Now they filled in the gap. And like you said, that 6140 area, we're right on top of that very important multiple time frame participation weekly number that you were pointing out in the weekly earlier. Right? I mean, this is kind of the tug of war that goes on now as people try and, you know, the bulls and the bears have to duke it out. As far as, let's talk about the trade and the short this morning. Let's say I missed the short in A period, and you pretty much addressed this, Jim, but let's revisit it. How would I sell a rally in B or C period if the height of the rally is not against a reference point? Can you share some tips on how to recognize this just using the profile? Well, the C period did come into the prior day's range and get rejected. I mean, it kicked pretty fast out in the C period high there. So if you had your line drawn on Wednesday's profile, you could use that as something to lean on, correct, sir?
You could. But, I mean, the question, like I said, I mean, I understand everybody said, well, I missed it. Now, where would I have gotten in? And like I say, it didn't allow me, the way I trade, and I'm not a chaser. I'm in the market every single day. And guess what? If I miss a day, I miss a day. There's just no shame in that. And what I'm not going to do is I'm not going to let myself get emotionally out of line. Like this morning, I did not see, I know that's a lie. You say, well, how could you miss that? Well, it never gave me what I wanted. It never gave me a decent enough bounce. Even if it would have gone back to half back or something like that, I just never saw a decent enough bounce to give me a place I was comfortable getting in with. And like I say, one of the things I should do more, but I don't chase the markets. The only time I sit down here, when C period, you know, came back up into the range and there was no follow through, you could have shorted right here. You know, it's a legitimate place to short. Let's say I probably wouldn't, it's just my nature, but remember, I've got a lot of scars from a lot of years, and there's sometimes if I'm really not in touch with the market, I'll just pass. And I clearly was not in touch early this morning with the market. Anyhow, sorry for making all those excuses. It's very embarrassing. Okay, other comments?
Because you do not have a buying tail here, does this make it not so good probability trade to the upside?
Correct. Now, again, it depends, like I've said so many times, it depends on how agile you are. Sometimes a poor low can it be an indication that the market is too short. Okay, and that could be right now. You could be getting a liquidating break in here. I mean, you could get a short covering rally in here, but it is not a high quality. It is not a high quality low. Going along against that low is you know, it may work, but it's a high odds. It's a low odds trade.
Okay, and because we had so many requests for the slides, I did, for today's slides, right before the webinar started, I put them at the website at the post. So if you want to have those to help you review, the slides are with this post. It's now under upcoming webinars, but when we end this webinar, it'll become a recorded webinar as I change it over with the recording. But the slides will remain with the post. So if you want them, there they are. Aren't you going to need the market to stop one time framing before you would get long?
That's, you know, everybody does it differently. I mean, I don't care. I don't care to get long with a market that's one time framing lower. H period has looked a single tick above H, and sometimes that single tick is where they come in and sell it at. You know, so yeah, the one time framing, very, very important, and so far it hasn't stopped. All right, let me say thank you. Julie and I will look forward to Monday as we start the fall intensive. Once again,
yes.
You got a lingering question there? Or
no, go ahead, sir. Go ahead.
Thank you, guys. Bye.
All right. Thank you, Jim, very much. Thank you for the extra time, and thank you, everyone, for hanging in there and for being here. It's great to have you. Intensive traders, you will be getting site credentials if you aren't coming from the summer intensive or prior intensive. If you're new, you will be getting site credentials today and tomorrow. So get ready and check out the training site over the tomorrow and hear how it's helping you, or if we